Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Alex Kech, Head of Digital Securities at SDX, which he joined in November 2022 from Citi Ventures blockchain and digital asset team in Switzerland. Prior to that, Alex founded On-Chain Custodian, ONC, the Singapore and Shanghai-based digital asset custodian and prime broker, which he founded after 17 years with Swift, including 7 years in Asia. Our topic, it will not surprise you to learn, is the future of the digital asset markets. Alex, thanks for joining us.
Thank you for having me.
Let me start with a big question. How do you expect tokenization to happen, and in particular, how it's going to achieve scale? Is this going to happen through the migration of the existing securities markets, equities and bonds, for example, migrating to blockchain, or is it going to happen through the construction of a parallel native digital asset industry?
I think it's going to be the second. So we are currently building a parallel avenue for issuance of digital assets for traditional instruments like bonds or private equities, for example. And that's really the objective here, is to build, leveraging blockchain technology, a new settlement infrastructure that can progressively open up and become global, while the traditional infrastructure is still running. And importantly, we also want to make sure that we can bridge traditional with the new infrastructure through a link that we've established, for example, with the SDX infrastructure, for the purpose of ensuring that we're not disrupting the market with our new technology. We're enabling the market with new capabilities.
As you've just pointed out, you've kept the old infrastructure going, if you like, alongside the new one, and the issuers which you've hosted at SDX, both the SDX, your parent company, and UBS, they both issued onto the existing infrastructure, but also onto the new infrastructure. Now, that's obviously part of your strategy, but did the outcome of that exceed your expectations? Did you see more people moving on to the new infrastructure as opposed to the old one? I'm talking here of investors. Were you surprised by the outcome at all?
So I guess the outcome was to reassure the market that issuing natively on a blockchain-based system is not damaging them in terms of quality of the products and access to the products. So that was the first objective of having this ability to dual lists on the traditional exchange and the new exchange, and also to settle at the traditional CSD and the blockchain-based CSD. So now that we have reassured the market that works, we do see an influx of interest from the issuer side, but also from the members side in terms of joining SDX to start actively primary markets trade and secondary markets trade on the infrastructure, as they becoming more comfortable with, for example, the funding requirements around atomic settlements, and so on and so forth. So the objective is really to have them learn with us as we deploy more assets on the platform, and as we deploy more services on the platform as well.
Now, you just mentioned you're seeing increasing interest from issuers, you're seeing increased membership. But as you look across the marketplace, which group, because there are lots of different entities involved in making tokenization happen, not just the issuers and the investors, but also all those intermediaries, those banks and private banks and brokers and asset managers. Which of those groups is proving easiest to persuade of the merits of this, and which is proving most difficult? Because you have to bring all these different groups onto the platform, don't you?
Indeed, especially knowing that the membership of SDX and SDX are banks and securities firms, so we're not directly talking to the issuers. So it's important, obviously, to ensure that these existing members find an interest in using our services. I guess the easy part is that the banks that we have engaged with are all convinced and aligned with our vision that most likely anything of value in the future will be tokenized on blockchains, and I use an S on purpose, at least at this stage. And they are developing their own capabilities internally to deal with digital assets, to deal with nodes on blockchains. So if our infrastructure can help do that with real transactions, they see it as an opportunity to try it out in a production live environment for some assets that they're comfortable with doing today. So it's bonds, but it's also private equity, where their current process is not ideal today. It's very manual. So there we bring immediately value to them, not only to the issuer, but also to the agents that are supporting those issuers in ensuring that those private shares can be in tokenized form and therefore become bankable assets for their investors, and also to help them orchestrate the whole process of managing those private shares, which today is most of the time done on Excel spreadsheet or only at registry services with no transparency and no or less visibility, I would say, than in an open infrastructure like we have.
Mm-hmm. I'll come back to what you've just said about private equity and that registration function in a minute, but just before I do, this is clearly not just about Switzerland. This is an international strategy you have here, and the Swiss market is set up both legally and in terms of the infrastructure you've built in one way. How much does it matter that not all markets you might be looking to be active in have reached the same level of development? I suppose, you know, there are variations between different national markets. Switzerland, as you say, is full of banks. Your own organization is owned by banks. So are you having to adapt the model as you talk to other markets because they have different structures, different histories, and different levels of legal and infrastructural development? It's complicating.
Clearly, yes.
Yeah.
Yes, clearly, yes. But our focus is the low-hanging fruits in the sense of we focusing on jurisdictions where there is a similar approach to Switzerland. So Singapore is one. There we have a joint venture with SBI and SIX called Asia Next that is providing services for not only crypto spot and crypto derivatives, but we'll also look at digital securities or securities tokens offerings, like they call it in that jurisdiction. So quite interestingly, there we see potential for creating those liquidity corridors and starting building those global liquidity access that we want, we believe will be the future. Beyond Singapore, Germany is an interesting country where the law has evolved to enable tokenization on blockchain of securities, and that helps as well. So we're looking at how we could maybe use Germany as a first step in Europe for expanding our services. So I would summarize by saying that it's a cautious and step-by-step approach that we're taking in terms of internationalization, because it's, as you said, it's not easy necessarily, and all jurisdictions are not fully aligned. But this is clearly an intention that we have.
You are clearly making progress in jurisdictions like Singapore and Germany, where there has been legal and regulatory progress to make it easier to tokenize assets. But I've kind of taken it as read that Switzerland is absolutely fine in that respect. But perhaps I'll just ask the question, do you face any serious legal or regulatory obstacles to getting tokenizations done back home in Switzerland these days?
Not really, because the law enables, well, there are multiple legal regimes that enables a licensed exchange and CSD as we are to operate on a blockchain setup. There are DLT laws in Switzerland enabling direct issuance on public blockchains. We actually making sure that we can bridge those two worlds, because we're currently working on a private blockchain setup. We want to make sure that we can also link to the public blockchain assets, if you wish, and ensure that our customers have access to both. I guess the challenge we are confronted to is that when you look at the MiCA regulation in Europe, it will enable CSDs to not only offer custody and maintenance and management services for what they currently do, digital for securities, but also for cryptocurrencies and for DLT securities or crypto securities. So what we see then, well, Switzerland actually does not have that capability. So as a CSD, I can only deal with securities. I cannot deal with Bitcoin and ETH and cryptocurrencies. That's why we have a separate legal entity to do that. So these are discussions we want to have with our regulators, obviously, to say, telling them and our lawmakers to tell them, well, look at Europe. If we do not progress and continue to be at the forefront of regulations in this space, we will be caught up by a competing marketplace. So that's the type of discussions we continually having with regulators and lawmakers to ensure that we keep our edge in a way, not as a commercial company, but as a market and as a country.
Mm-hmm. You mentioned a private blockchain, private assets as low-hanging fruit. Now, Switzerland famously has a lot of small and medium-sized companies in it. Are they the classic low-hanging fruit? Are they very attractive as targets, clients, for what you're trying to do?
Yes, on the private share side, we definitely have a nice playground in Switzerland and don't really need to go beyond Switzerland for the moment because there is a lot to do. There are like dozens of thousands of SMEs and fintech companies in Switzerland operating privately, and we see that those companies are staying private longer and sometimes that never become public companies. So they've been historically underserved in terms of how private shares are managed, how their shareholdering structure is managed, how transfers of ownership between various private owners of the companies are done, inheritance, and so on and so forth. So the objective of SDX here is to build an ecosystem where we can not only tokenize private shares and ease the settlement of those private shares, the management of those private shares, create transparency for the issuer and so on, but also to help with funding of those companies as they go through their life cycle before they become public or even if they never become public. So in that regards, we are building what we called funding support platform where the various actors involved in funding rounds of those companies, banks, VCs, investors through private banks, for example, can connect, see deals that are available, find the necessary information to make a decision on whether it's a good investment or not, and therefore participate to various funding rounds throughout the life cycle of the company. So it's not only about tokenizing its private shares and making them transparent and easy to settle and easy to hold and easy to move around, but it's also about facilitating the additional funding events of those SMEs and those fintech.
Mm-hmm. You've used the term funding support, and obviously raising capital is the primary benefit of working with you for these private companies. What's the rest of the sales pitch? What other benefits do you talk to them about? You mentioned much earlier on the question of share registration. Perhaps for the first time they can get a properly organized cap table or share register set up. And I assume cost is an advantage here. It's a lower cost of capital for them. But when you're talking to these issuers, these private company issuers, what does the sales pitch consist of?
As I mentioned, it's really about mostly orchestrating and helping them with the administration of their shareholders. And through partners that we have, Share Registry offering support for General Assembly meetings or assembly meetings and other corporate action events or events, we can then make that experience of funding a startup and building and growing a startup, or funding an SME and founding an SME and growing an SME easier, without the risk of losing track of who actually owns your company, which sometimes happens. You would be surprised, and ensuring that you can easily progress, if that's what you want, towards a IPO that will be sound and organized, because you will be clear on your private during your private journey. So that's the main I would say, pitch for the issuer side, for the investor side and the bank servicing the investors, and I think it's important as well, is that we make those private shares bankable assets. So today, if I'm an investor in SME in Switzerland or a startup, I don't see my shares on my bank account because they are either in a drawer, in a paper piece form, or in an Excel spreadsheet somewhere, or sometimes I could lose track of it. With tokenization through the SDX platform, those assets become bankable assets, get an ISIN assigned, and I see it, and I can see it in my custody accounts at UBS, for example, which is quite neat, not only for the investor side, but also for the issuer side as a service in a way to their owners, their shareholders.
Yeah. Now, private companies issuing tokenized shares is one thing, but what about funds, including, I might say, private equity funds? Are private equity funds, real estate funds, venture capital funds on the one hand, the alternative funds, you might call them, a target, but are also retail funds, UCITS, AIFs, are they also attractive targets to SDX as issuers rather than investors?
Yes, definitely. So this is the next topic that we're talking to VC, for example, and other private fund issuers. So we are in early discussions to enable a similar process that for private shares for private equity funds, for example. And that, by the way, is through discussions with banks who have their own tokenization platform and are doing that for the benefits of their customers. But what we, in discussion with those banks about is, it's great to build a tokenization platform on your own that is accessible to your customer base. But what about we make those instruments also accessible to investors at other banks that are banking with UBS or another private bank in Switzerland, for example, and that resonates. So we will have some news to announce in the next 6 months around that because it's clearly a target for us to expand the platform with new asset types and beyond the bounds of the private shares that we currently have.
That's a very interesting observation you've just made. Can I press you to tell us a bit more about it? Because there seems to be a trend occurring where, as you point out, banks are building, if you like, their own tokenization engines. They obviously have access to groups of issuers. They have access to investors, and this is happening not just in Switzerland, but it's happening here in the UK, for example, and in other markets as well. So, how do you expect this ecosystem to evolve if we've got lots of different tokenization engines tokenizing assets, possibly in a non-standardized way? How difficult is that going to make it for investors to access these different assets in a seamless way? And how difficult is it going to be for issuers to make sure that they maximize the value of the issue they're making? How do you expect this, what is becoming quite a fragmented, complex ecosystem on an international scale, how do you expect it to evolve? You've hinted at it with, make your assets available through us as well. Is that how this is going to happen looking forward?
I would say yes. So I see two evolutions. So yes, today these individual banks are creating tokenization platform on different blockchain setup that don't necessarily talk to one another. I think one of the trend will be that the choice of blockchain of those banks will evolve towards a standardized setup. It could be a Canton blockchain that had been announced recently. It could be a Corda, a blockchain that everybody's using. It could be even a public blockchain. So assuming that it's progressing in that direction, you will end up with a interoperable infrastructure that will enable assets tokenized by Citibank, for example, to be held in a wallet that is managed by UBS for a private customer of them, for example. We do see also us FMIs playing an important role in bridging those various setups and creating that interoperability. So until this blockchain-enabled interoperability is a reality, which will probably take 10 to 15 years to be fully honest, FMIs like SDX can be the bridge between individual setups and markets, the entire market. And that's what we're discussing with banks, and they are quite interested in this idea, actually, that as we're playing a neutral role today of market access to liquidity, we can play exact same role, but in a blockchain context with these tokenization platforms.
SDX operating as a bridge across these multiple tokenization engines platforms is an interesting way of looking at how the market is going to evolve. It prompts a thought in my mind is you're kind of taking away the operational burden of accommodating themselves to this market from the banks, which prompts in my mind a more substantial, more general question is how much operational change. We've talked a lot about the issuers and the investors already. We haven't talked that much about the intermediaries, but here you are saying we can make your adaptation, Mr. Intermediary, to this marketplace much easier. But how much change do the existing intermediaries actually have to make to operate in what's going to be a pretty complex tokenized ecosystem initially? Things like settling atomically, operating their own nodes, running their own engines. How disruptive is this change going to be if you're a bank or a broker looking to service clients?
It is a gigantic disruption, if you want my view, because you are ripping off your heart in a way and putting it in common with other infrastructures. So you're instead of running your own ledger, you're going to share that ledger in a way with others in a blockchain, and that's just technologically is a major challenge for banks who are still in some case running on COBOL-based system, or if not COBOL-based systems, technologies that are not adapted for listening to an external ledger and reflecting those positions into the account of the customers without having full control of that ledger, if you see what I mean. So that's a major paradigm shift for them and for us as well as a CSD, for example. But we can discuss about that later. The good news there is that all the banks I'm talking to, they have clearly plans and programs in place to enable node management, enable wallet services and wallet management to progressively deploy services on this new technology, and probably less progressively, but it will happen, opening up to globally, I would say. So if we can help in the intermediation or in the interoperability of those various setups while it's opening up, I think it's something we should do. But it will also position us very well to start deploying services that can leverage on assets that are issued by the various banks in their various ecosystems. That's on the technology side. On the operational side, treasury management, for example, there are clear challenges to move from, well, there are challenges already today to move from T+2 to T+1. We see that in the US. People are ready to do that now, but the ultimate objective is that everything will be instant, like it is in cash nowadays, like FX, the FX market is pretty much today. That's going to be the expectation for securities as well in the future. So moving from a T+2 funding paradigm to a pre-funding paradigm to enable atomic settlement is something very complicated to manage for most banks, which is understandable. So it's also our role, in my view, to provide solutions such as the ability to, for example, reverse repo for 2 minutes the time for settlement of a transaction, because you don't have the cash until you have the time to move the cash into your node, for example. So those type of things we are looking at doing and offering. That's the extra value and service that we can offer as an FMI, or as a DFMI, a digital FMI, as I call it, as we go and as we grow with our community.
Yeah, if you thought switching to T+1 or T+0 was difficult, switching to atomic settlement is that problem on steroids, isn't it? Now, you mentioned en passant that you are obviously operating a digital CSD here. If we'd had this conversation, as I think we did 2 or 3 years ago, we'd probably spent quite a lot of it talking about whether CSDs and indeed custodian banks would survive tokenization. Would they or would they not be disintermediated. I think it's now clear that not only are both these types of institutions still with us, it's pretty clear that they are here to stay because they're fulfilling useful functions. So what does that tell us about the maturity of the debate about tokenization, that we're no longer having this discussion about disintermediating CSDs and custodians, but talking about how they're going to help this happen? What does that tell us?
Well, it tells us that CSDs and custodians do not only safekeep assets and settle assets for their customers. They also performing important roles, such as, at least in the let's look at FMIs, as being the entity that is responsible for making sure that the markets function as it should function, and that the regulator has someone to call if something goes wrong. So the role we see ourselves playing in the future will not be looking at all like what a CSD is doing today, but it will still be an important role in the sense of we will be, in our view, the entities that are deploying multi-party services on blockchain, like a Uniswap or Aave for institutional, and make sure that the smart contracts, for example, that are deployed are sound, have been audited, and that if something goes wrong, the regulator has someone to call to and blame, actually, as well, for any issues that will take place. That's one role. The second role is giving access to those services. So it's not going to be like Uniswap and Aave today, where anybody with a wallet can access. Obviously, for institutional grade type of service on blockchain, you need someone to KYC institutions to make sure that institution A can have access to this type of instrument and that type of service for regulatory based on regulations. And that's still a role that a centralized operator of services on a decentralized infrastructure will need to will be playing and will be needed actually. On the custody side, the banks, as you rightly said, will have to operate differently technologically, but I do not expect you and me and other retail investors to want to manage their assets directly, even if the blockchain theoretically could allow them to do so. What will likely happen is that they will delegate that management of assets, like they do today, to banks that can offer them additional value-added services on top of just safekeeping the assets for them. So that's not going to change in my view. There will be more competition on both sides, FMIs and bank sides, which is good. But fundamentally, just for regulatory reason, I think FMIs will continue to exist. And for convenience point of view, banks will continue to exist as well.
Banks and FMIs will continue to exist. And certainly in the short term, I imagine they're going to carry on doing a lot of the things that they do. And if I could abstract the function which they spend a lot of their time doing, it's actually moving information point to point. These famous reconciliation processes, they're exchanging messages, often in Swift formats, adding a bit to it, passing it on. So in a fully tokenized market, when this vision is fully realized, those point-to-point information exchanges are not going to be necessary anymore. What do you think those financial institutions, those custodian banks, and those financial market infrastructures, the CSDs, if you like, what are they going to be doing when those core point-to-point information exchanges are no longer necessary?
Well, they will continue to offer other services, which is, well, wallet management, for example. So access to those blockchains in plural, or it maybe one day to that blockchain, and securing of those assets which are cryptographically held on those blockchains. So it's quite important to ensure that there is no issue with the safekeeping of those assets. So traditional custody, if you wish. I think they will also be able to offer innovative new type of financial services around that are still unknown at this stage, to be honest, because of the technology. We could, for example, expect that as more and more valuable assets are tokenized on blockchain and very easy to manage, you could imagine that Lombard loans type of will be easier to operate and therefore to offer, meaning you can use anything as collateral at one for any financial needs. So because it's easy, because it's held in the same wallets, because it's in tokenized form, and because it can be moved and 24/7 if need be. So that's the expectation. So those banks financial institutions will continue to intermediate for their customers towards that new infrastructure, and will creatively likely come up with financial products that are for the interest of their customers, thanks to that technology.
We've talked about how SDX is looking to collaborate with the banks who are building their own tokenization engines, but SDX is also working with other tokenization platforms in Switzerland. Is the thinking behind your collaboration with them, your strategy behind your collaboration with them, exactly the same as you're thinking with the banks, or is it something different?
It's similar. Anybody that really is enabling tokenized issuance of tokenized assets, be it on public blockchains or private blockchains, we should have as an objective to connect with them, because the ultimate objective is to make tokenized assets accessible to investors. I always say there are only two entities that matters in our world of capital market, is the investor and the issuer. Anybody else in the middle is someone that is supposed to support the access of the investor to the issuer's assets and the management of those assets by the issuer, nothing else. So it is in the investors and issuers' interest that we connect with any actors, be it bank or fintech, that is enabling tokenization, because ultimately we're serving the same customers, so servicing the same customers. So we obviously connect to a tokenized registry like Actionariat, for example, in Switzerland, with the purpose of accessing the issuer, and then we do the same on the bank side to access the issuers and the investors. So it's always with the same purpose: connecting issuer with investors and making sure that everything works.
If you are to realize that vision of a interoperating network of different tokenization networks, a sort of network of networks, I suppose, and you touched on this earlier, this interoperability depends ultimately on seamless exchanges of data between these different networks, these different blockchain protocols, and indeed ultimately with the traditional financial services industry as well. So we all agree interoperability is vital to realizing the vision. Does that mean standards? How ultimately can that, and you said earlier this could take 15 or 20 years, but what steps can be taken now towards realizing interoperability through the use of standardization or other methods? How do you think that interoperability problem can be tackled now, how it should be solved starting today?
Well, clearly by reusing any existing standards out there in terms of identification of instrument, for example, or even design of APIs to access blockchains, why not? ISO 222 could be used for that as an example, but there are specific standards that are being created and have been created to support tokenization. Digital token identifier is one of them, ISO 24165, that really enables you to uniquely identify a token on its blockchain, which is important if you are in a multi-blockchain setup. You could imagine very well that a bond issuance with the same ISIN could be on 3 blockchains in the future, because it's a fact of life, because there's a reason for it. And you need to be able to clearly identify, especially for a company like us who wants to interoperate and bridge those blockchains, which one is which, right? So those type of standards are critical, and we are working with the DTI Foundation to ensure that every time we have an issuance, we are issuing a DTI for it, or sets of DTI in the future when we will issue on multiple blockchains, you never know, or make them available on multiple blockchains. So that's an example that is significant. So yes, standards are critical. Reuse of existing standards when they are relevant, and creation of new standards when they don't exist is critical. And I would add there that there's also an important role for industry groups such as ISA, such as GDF, Global Digital Finance, on the crypto side, to collaborate, and they do, to build market practices and best practices around how custody should be done. And ISA and GDF recently or are about to publish a document on a white paper on this. These type of collaborations are essential to ensure that this interoperability, or that bridging of chains until one chain maybe eventually emerge, is done in the most efficient way.
Mm-hmm. One way in which we'll be able to tell that the vision is getting closer to realization is when we see liquid secondary markets in tokenized assets developing. What services do you think we need to develop now to support that type of liquid secondary market emerging? I'm thinking here of things like market making. You know, we've talked a lot about the primary market, but the secondary market, what's needed to make that happen?
Well, market making is clearly an important component of the existing financial infrastructure that needs to be somewhat replicated on the digital version of that market, and that's happening. So if you look, always look at what's happening on Ethereum to understand what could be the future of blockchain. And when you look at what happens on Ethereum, on Uniswap type of service, for example, you have automatic market making, where people with excess tokens of one sort can make them available for market making purpose and earn a reward, as they call it in the crypto space, to avoid the regulators going after them, but interest in other reason, and fees. So that's a model that I think can be replicated for institutional as well. But the traditional way of doing it could also be used. So you could imagine a DEX, a decentralized exchange, that has in which traditional market makers have access to and provide liquidity when required. Another way of dealing with that challenge would be, and especially the pre-funding challenge that we discussed in the atomic settlement part, would be to create Aave-like services, but for institutional, where you can instantaneously borrow an asset that you need for settlements and then reimburse your borrowing even 5 minutes later by providing back those instruments once you've done with your settlement. So those things will be put in place progressively in the institutional space as well. But unfortunately, we can't just copy paste what happens on Ethereum, because this has been built for retail usage clearly, and is not to the level of robustness that regulators and banks and FMIs would be comfortable with deploying for institutional customers and institutional use.
Talking of automated market making, I saw an experiment the other day in which a central bank was investigating whether automated market makers could play a role in integrating central bank digital currencies into the settlement and trading process. Now,
Mariana project, right?
That's right. Yes, exactly.
Yes.
Thank you for reminding me of the name.
Yes.
It prompts a thought on my part, which is that SIX, your parent company, has been working with the Swiss National Bank for a long time on integrating central bank digital currencies into the settlement process, and you're about to actually do this for real. What's the true significance of that? You know, seem to have been waiting for years for fiat currency to be available on blockchain networks. Is this about to happen? Is this a truly epochal event that's about to occur?
It is, because it's going to be the first time that a production deployment of wholesale CBDC will take place. In the past, it has been about proof of concept, trying it out, maybe doing one transaction to see how it works. Here we're talking about a series of transactions, if we follow the announcement by the Swiss National Bank, that will be enabled on the SDX platform and will be paid in wholesale CBDC that the central bank itself will tokenize on our platform. So clear, really central bank money, settlements on our platform in the form of wholesale CBDC. So that's a essential first step towards anything else, really. In parallel, I don't know if you're aware of that, but the Swiss Banking Association is looking at models on how they could start tokenizing deposits and start exchanging tokenized Swiss franc deposits for Swiss franc between various retail and corporate companies in Switzerland. Very early stage, but that can only work, in my view, if you have a wholesale CBDC anchor at the bottom to ensure that when a token moves from UBS to ZKB, Zurich Cantonal Bank customer, that there is a clearing happening between those two banks. And the ideal setup, if everything is tokenized, is that the tokenized deposits are on blockchain, but also the wholesale CBDC are on blockchain to enable this. This is very much the regulated liability network that has been tested recently in the US and the UK in terms of concept. And that will also probably also the fact that we're going to start issuing wholesale CBDC for DVP purposes first on SDX is opening, hopefully, doors to other discussions with the Swiss National Bank and the banking sector in Switzerland to see what else can be done and what else can this wholesale CBDC enable in terms of use cases and in terms of processes.
We're having a very forward-looking, positive conversation here about primary market issuance of tokens, secondary market trading. We've just been talking about how the settlement process is going to become more efficient, how the trading process has become more efficient by adapting innovations from, as you point out, the Ethereum blockchain, automated market making, automated borrowing and lending. We're going to have CBDCs on chain and so on. And on the other hand, the industry which gave birth to all these innovations, the cryptocurrency industry and its offshoot in the decentralized finance industry, which gave us things like Aave, they've had a very tough 18 months since the bear market set in, I think, in November 2021. Yet we haven't really touched on that at all. Is what's happening in the cryptocurrency and DeFi markets kind of irrelevant to the digital asset strategy at SDX? I know you have a separate subsidiary dealing with that side of things, but when you talk to customers, are they saying, well, you know, the cryptocurrency markets are not doing very well, or have these two industries become completely decoupled now?
I wouldn't say that. When you look at the last 18 months, we've noticed two things: is that DeFi, purely decentralized finance services on Ethereum, like Aave, like Uniswap, they really had no trouble, no issue during those last 18 months. They functioned as they were expected. They were coded to function through the smart contract. People who had to be liquidated because their collateral level was not enough have been automatically liquidated, and so on and so forth. So the system has worked as it should have in the DeFi space. What has not worked in the crypto space in general is unregulated, badly governed, with with awful risk management CFI services, centralized financial services, such as FTX, for example. These are not DeFi offerings; they are CFI offering, which is very essential to mention. So I think it's going, this 18-month of nightmares for many retail investors, I think, is pushing the whole industry in the right direction. So more trust into a DeFi type of approach, where you don't have that, where code is actually deciding on what should happen and not human beings with bad intentions. And then more regulation and more requirements for governance and proper risk management of the centralized services, such as the exchanges, the crypto exchanges, or the lending platform, such as Celsius, for example. So I think it is good. It clearly slowed down the appetite to do stuff in this space for customers of ours, but we do not see oh, no, we're going to stop everything. It's more like, yeah, let's make sure that we playing with the actors that make sense. So we using custodians like SDX, who have this culture of risk management, this culture of security, and therefore we can trust more than another custodians in the crypto space. That's one. And second is, how can let's position ourselves in terms of starting off to offer services in that space as a bank, rather than letting our investors, our customers, deal with unreliable service providers in this space.
One final question for you, Alex. You're on the record somewhere as saying that you believe everything of value can and one day will be tokenized. And coming from somebody of your background and experience, that's a non-trivial statement. So how long do you think that vision of yours, that transition to this fully tokenized future, how long do you think it's going to take?
It's the 1 million question, right? If I would know, I would be able to bet, and I would be I would stop working immediately. But unfortunately, it's a difficult question. When I'm asked, I generally say between 5 years and 15 years. So 5 years to start seeing something that is substantial in terms of issuance, trading, and real activity at global level. So starting by countries and then progressively becoming global. But for the entire capital market ecosystem to be tokenizable and tokenized, that's going to take an extra 10 years. So in my view, so it's going to be between 5 and 15 years. And I might have chosen that 15 years because it's when I will retire normally, unless they move up the age of retirement again. But it might be a psychological answer, but I think that's going to be long, because it's not something trivial to do. We're not moving data here, we're moving value around, and that's way more complicated to do than managing data or managing something else on the internet, for example.
Alex Kech, thanks very much for taking the time to talk to the members of Future of Finance.
It was my pleasure. Always great to talk to you, Dominic.